Welcome back to Retire Right, the podcast where we break down the complex world of retirement into simple, clear conversations. I'm your host, and today we're diving into a big one, something most people don't fully understand until they're right in the thick of it. Today's topic is final distribution transactions from a 401k plan. Now, I know, that probably doesn't sound like the most thrilling episode title, but trust me, this one matters. Whether you're retiring, changing jobs, or facing a life event like divorce, this episode will give you the complete picture of what happens when you take that final step and withdraw your 401k money. Part 1. The final goodbye to your 401k plan. So imagine this. You've just left your job. Maybe you're retiring. Maybe you've taken a new position. Or maybe life just changed directions. Whatever the case, your 401k is now sitting quietly, waiting for you to decide what happens next. This is what we call a final distribution, your last move with the plan. You're choosing what to do with the full balance of your account. Do you cash it out? Do you roll it over into an IRA? Or maybe a new 401k? Either way, once this happens, you've officially closed your chapter with that employer's retirement plan. The process usually starts one of two ways. Online through your plan's website or by calling a service center. They'll walk you through a series of choices. And here's where it gets real. You have to tell them how much of your account you want to cash out, meaning you get the money now, but taxes are coming. Or how much you want to roll over. When you roll over, you keep the tax advantages and avoid penalties. But you'll need to provide the name of the institution you're rolling into. That's key, because that's who the check gets made out to. Now, here's a twist you might not expect. Let's say part of your 401k was invested in company stock. What happens to that? You might have the option to receive the stock as stock, not cash. This is called an in-kind distribution, and it could have big tax advantages. There's a concept called net unrealized appreciation, or NUA. Long story short, it means you could end up paying capital gains tax instead of regular income tax on some of that stock. That's a win in the tax world. But you need to ask your plan about it. Not all plans handle it the same way. Okay, so you've made your choices. Now what? For most daily valued plans, if your request comes in by 4 p.m. Eastern Time on a business day, they'll start processing it that night. Your check is usually in the mail within 3 to 5 business days. But here's something people don't always expect. You might get more than one check. Let's say you chose to roll some of your money over and take some in cash. Well, you'll get a check for the cash out, minus taxes, of course, and a check for the rollover, made out to the new institution. Sometimes, if you had both Roth and traditional money, you could even see 3 or 4 checks. And here's a small but important point. Even rollover checks are mailed to your address. That freaks some people out. They think, wait, is this going to be taxed? But no. What matters is who the check is made out to, not where it's sent. Quick detour here, because there's a common mix-up. A withdrawal is when you take out just part of your money. A final distribution is when you take it all and close the account. Big difference. With withdrawals, the account stays open. With final distributions, the door is shut and locked. Also, if you had a loan from your 401k, it will be defaulted as part of the final distribution. That loan becomes a distribution, which means, you guessed it, more taxes. Possibly even penalties if you're under age 59 and a half. Now, let's say you leave your job and just forget about your 401k. It happens more than you'd think. Well, if your balance is small enough, the plan may make the decision for you. Here's how it works. As of 2025, if your balance is under $1,000, they may cash it out automatically. You'll get a check, whether you're ready or not, and taxes are coming. If it's between $1,000 and $5,000, they have to roll it into an IRA for you. This is called a default IRA, and it'll likely be at a partner institution. Over $5,000? They can't touch it without your consent. It just sits there until you act. One quirky rule. Some plans only check your balance once, right when you leave. Others recheck every month. So depending on your plan, even if your balance falls later on, it could still be cashed out. Let's fast forward to retirement. You're done working. Maybe you're enjoying life. But there's one more rule to follow. The IRS says you must begin taking money out of your 401k starting the year you turn 72, unless you're still working. These are called minimum required distributions, or MRDs. If you're retired, You must take your first MRD by April 1st of the year after you turn 72. Miss it? You could be hit with a 50% penalty on the amount you didn't take. Ouch. Now, if you're still working at 72 and you're not a major owner of the company, you can wait. But if you own 5% or more of the business, you're taking those MRDs no matter what. And here's another tip. The IRS does not let you roll over MRDs. Once you take it, it's taxable. Period. Time for a real-life scenario. Let's say you go through a divorce, and the court says part of your 401k needs to go to your ex-spouse, or maybe even your child. That's done through something called a Qualified Domestic Relations Order, a QDRO. It's a legal order that tells the plan to split your 401k. But here's the kicker. It has to be approved by the plan. Until then, nothing happens. And while it's pending, your account is usually frozen. No loans, no distributions. Once it's approved, the alternate payee, the ex-spouse, for example, gets their own piece of the pie. They can roll it over or take a distribution, depending on the order. One quirky tax rule here. If the recipient is a child and they take a distribution, you, the participant, are taxed. But the 10% penalty doesn't apply. Strange, right? All right, last piece of the puzzle. Taxes. Every time you take money out of your 401k, you get a document called a Form 1099-R. This is what tells the IRS exactly what you took, how much was taxable, and whether penalties apply. Even if you roll everything over, tax-free, you still get a 1099-R. It'll say zero taxable, but it still has to be reported on your tax return. You might even get multiple 1099-Rs in a year, especially if you took money from both a Roth and traditional 401k. These forms are required to be mailed out by January 31st every year. So keep your eye on your mailbox or your inbox early in the year. So there you have it. Final distributions from a 401k aren't just about hitting the withdraw button and watching the money roll in. There are rules, tax traps, timing issues, and options that can either cost you or save you thousands. And the good news? Now you know the difference. I hope today's episode gave you clarity and maybe even confidence as you prepare for your next big financial move. If you found this helpful, consider subscribing, leaving a review, or sharing with someone who's planning their next step. Take care of your future, and it will take care of you.